Corporate Finance Core, Topic 1, the Corporation, Financials, and Excel. We're going to go with Section 2, understand the construction and analysis of the balance sheet, income statement, and statement of cash flow. So we'll start with the balance sheet. Balance sheet is a snapshot of the firm's assets, liabilities, and ownership as of a certain date, as of, say, December, the last day of the year in 2018 and 19. Now, under GAAP, the generally accepted accounting principles, the assets are reported at cost, not their market value, and that becomes very important. So, for example, later if we look at, say, property, plant, and equipment, that property might be downtown Manhattan, however, it was purchased 30 years ago and doesn't reflect its current value. Also, assets and liabilities are usually listed in order of liquidity. In other words, the ability to turn them into cash or sell them. So let's look at the components. So again, we have assets, we have liabilities, sometimes called debt and equity. And so here's our liabilities here, here's our equity, and here are our assets. So let's look at the assets. So the most liquid asset is cash, actual cash sitting inside, drawers. Also cash equivalents, which includes safe short-term investments. You have accounts receivable. So accounts receivable are, again, assets. So these are uncollected or credit sales. Now, inventory is included in finished goods, work in process, and raw material. So then again, in order of liquidity, we have cash equivalents, we have accounts receivable, we have inventory, and now we have our total current assets, which includes those three items. And now we have our non-current assets, or sometimes called fixed assets. So in the first one, we have property, plant, and equipment. So these are tangible fixed assets recorded at cost and then depreciated over their useful lives. So in this one, we have all three components of PP&E. We have the PP&E at cost. So that is the actual purchase price, the amount that was capitalized in the balance sheet at the purchase date of the asset, minus the accumulated depreciation over the lifetime of that asset. And then here is my net PP, property, plant, and equipment, PPE. And sometimes if you look at financial statements, it doesn't show these two, it'll just show PPE, and what you're looking at is the net amount, the original cost minus the amount that's been depreciated. And then you have your intangible assets, such as copyrights and patents, and then your total fixed assets and total assets. So as of the end of this year, they had total assets of 1,742. So this is basically a snapshot of the value recorded at cost of what they own, this corporation. Let's talk about how it's financed. Where did it get the money to purchase these assets? Well, the first one we'll talk about liabilities, and sometimes called debt in general. So accounts payable. So accounts payable are unpaid expenses. Say a supplier sent you some goods and you just haven't paid the bill yet. So that's included in accounts payable. If you think about that, that's really a loan. You've received goods, you've received something of value, and you haven't paid for it. It's really a no-interest loan. So again, how did I get some of these inventory items? Well, I purchased them, I haven't paid for it. So that's a source of financing, really. But we just call it a liability in general. You have other current liabilities that might be in there. And so you'd have your total current liabilities. You have your deferred taxes. So as you record profits, you owe taxes, but you pay taxes, say, quarterly or maybe sometimes monthly. So the amount of tax you owe but haven't been paid is kind of like a no-interest loan to the government. And then you have your long-term debt. So the long-term debt are long-term bank loans and bonds. Bonds are just kind of traded loans. And so this is actual acquisition of cash to make purchases of assets. And they're your long-term liabilities. Now, sometimes short-term loans will show up under other current liabilities or have their own category. And also the current portion of long-term debt will also be in a current liability. So for example, you get a 10-year loan. 9.5 years ago. So now it's only a 6-month loan. Well, now it's going to show up as a current liability. So here are your liabilities, or sometimes called debt. And so the last section is ownership. So you have preferred stock. So these are stock, usually with no voting rights. And then you have your common equity, which will also often include all 4 of these categories. So it would be the common stock, which is when you issued the stock, what was the value of it? The capital surplus. So that would be the amount the shareholders pay for the stock over its par amount. So if we add these 2 numbers together, that would be the total value of the common stock, or the total value that was received from the organization as they issued the stock. This would only, common stock would only include the par amount, and the capital surplus would be the amount paid over par. Often in the financial statements you look at on the web, they'll just combine these and call this common stock. You have the accumulated retained earnings. So if you think about a corporation, it's owned by its shareholders. So if the corporation earns profit, really the shareholders have a claim to that. Any profit they did not pay as a dividend goes under accumulated retained earnings. It's really an investment by its shareholders back into the organization. So accumulated retained earnings is an equity investment. It's money, again, that was earned by the organization that was not paid to the shareholder. The shareholder in some sense has agreed to and reinvest it back into the firm. And then you have subtraction of less treasury stock. So sometimes organizations will buy back their own stock. Maybe they have some extra money around. They don't want to buy any new fixed assets. They'll buy back their own stock. So that'll be the repurchases right there. So then you have your total liability plus equity, adding up these 2 line items. And notice that L&E, your liability plus equity, is exactly equal to your asset. It's the basic accounting identity. So I like to think about the balance sheet as really telling a story of what does the corporation own and how did they pay for it. So this organization has $1,742 in assets. It has financed it using $1,017 in debt and liability, and another $725 was kicked in by the owners. So let's talk about common size financial statements. If I look year to year and I see these changes, and if I were to say compare this organization to another organization, it would be very difficult to make comparisons, especially say organizations that have vastly different size. Right? You want to compare a brand new tech firm with, say, Microsoft or Apple. It would be difficult because of the scale. So what I'll often do is look at common size financial statements. We'll convert all financial statement items to percentages to allow you to see trends and make comparisons. Now for the balance sheet, you'll take every asset item and divide it by total assets. And for L&E items, you just take all liabilities divided by total liabilities and all equity divided by total equity. So we're going to convert this financial statement to common size. And here we go right here. So cash as a percent of total assets is 9%. So that would be 157 divided by total assets of 1742. And that has increased from 2018 to 2019. So what you see is the composition of assets is shifting more into cash and cash equivalents, and it's shifting, and it's a reduction in, say, inventory. So this kind of gives me an immediate trend that the company is holding more cash as a percentage of total assets, and there's been a reduction of inventory as a percentage of current assets. If I look at liability and equity, so I look at in 2018, if I take accounts payable divided by total liability, that was 34.9%. If I did that again in 2019, that was an increase in 0.1. So we say there's no real change in accounts payable as a percentage of total liability. One thing that has changed, there's been a reduction in long-term debt as a percentage of total liabilities. And if I look at equity, there's been a change, say here, in accumulated retained earnings has increased as a percentage of total financing. So you can start to see some trends or make some comparisons. Let's talk about the income statement for a few minutes. So unlike the balance sheet, which shows a snapshot of the organization's assets and financing, liabilities and equity as a certain date, the income statement is over a period of time. It's a performance of the organization over a period of time. It starts off always with total revenues, or sometimes called sales, and in Europe they'll call that turnover. And what that is the total amount of the cash and credit sales when an exchange of good or services has occurred. So in this company, the sales went from $2,200 to $2,262, which is an increase by $62. Sometimes people just talk about this as the top line. So they said, what was top line growth this quarter or this year? What they're just talking about is the increase in sales, and they're talking about the top line of the income statement. Now remember, total revenues only includes revenue or sales from a exchange of good or service. So an increase in the value of your Manhattan headquarters will not show up in sales. So income statement is not capturing the value of increasing market prices of assets. Now you have your cost of goods sold. The cost of goods sold is, or sometimes called COGS, is just the direct labor and material to make the good. SG&A, selling general and administrative expense, just called SG&A, or all other expenses to deliver the goods, as well as, say, the management of the company, the CFO salaries in there. So if I take my total revenue minus my cost of goods sold and SG&A, I get my EBITDA, or sometimes called EBITDA, earnings before interest, tax, depreciation, and amortization. So this is your first level of profitability that an organization will quote, their EBITDA or EBITDA. Sometimes it's called the operating profit, since it's only looking at operational items. It's not looking at, say, non-operating items like the sale of a piece of equipment or sale of a fixed asset, and it doesn't include taxes and interest. It's just operating expenses. However, I just want to make a note here. Depreciation sometimes is included into SG&A. However, I think more commonly it is not included in SG&A. So for the purposes of this course, if you see SG&A, assume that depreciation is not included. I'll always break that out separately. So I got my EBITDA. I'm going to subtract out my depreciation, and that'll give me my total operating profit before other income losses or gains. So let's talk about depreciation for a minute. Again, in the balance sheet, if a company were to purchase a long life asset, say a delivery van, that is not going to come through cost of goods sold or SG&A. All right, cost of goods sold and SG&A are often called operational expenses. All right, so think about them as just salary of the workers making the goods and the materials needed to produce the goods. A van is going to be used over, say, 5 years, maybe a useful life of 5 to 7 years. So you wouldn't record the total purchase of a delivery van or office furniture or a computer. That wouldn't flow as an operational expense through SG&A and cost of goods sold. It'll be what we call capitalized, which means it'll wind up as property, plant, and equipment, PPE, on the balance sheet, and then only some percentage of that delivery van's cost will be recognized through the income statement over the life of the asset. Again, say the delivery van had a 7-year useful life, and you're just going to amortize or depreciate 1/7 of the cost of the van using a straight line depreciation each year. So this depreciation is the percentage or some percentage of, or fraction of, the cost of fixed assets that are allocated to that year. So I take my EBITDA, I subtract my depreciation expense. That'll get me my operating income or loss. I'll then subtract any other income or losses, and that'll give me my earnings before interest and tax, EBIT, or EBIT. I'll then subtract interest expense, which may also include interest income, so this might be a net interest expense. I then have EBT, or earnings before tax. I'll subtract out my total tax, which sometimes will have the actual tax expense paid versus the taxes payable, the ones you haven't paid yet, and there's my net income. So this is sometimes called the bottom line, and it's often the last number reported in the income statement. I added a few extra line items to this income statement. This is the net income. This is your net profit or bottom line for the organization. I then might subtract out dividends. So this corporation earned $80 in profit in this year. It paid a dividend of $40. So that other $40, it then goes back to the balance sheet, and we're going to add it as an addition to retained earnings. Now this is the connection between the income statement and the balance sheet. Any profits, any net income not paid as a dividend goes as under equity as an addition to retained earnings. It's a $40 investment in the firm by its current shareholders. And here's just a note: in this organization, there are 29 million shares outstanding. So again, here's our income statement. We got our operational section, so your operational profits. And then we had non-operational things like interest expense and taxes, and got our bottom line of net income. Like the balance sheet, it's often hard to use the numbers to make comparisons. So what we'd like to do is common size income statements. So I'll take every line item and do a percentage of sales in that year. So cost of goods sold of 1,625 divided by sales of 2,200 gives me 73.9% as a ratio. So in 2018, this organization cost of goods sold was 73.9% of revenue, and that decreased the following year by 0.7%. So by instead of just looking at this number of 30, what we're actually seeing an increase in cost of goods sold, but sales increased faster than cost of goods sold. So actually cost of goods sold is falling as a percentage of net operating revenues. That's probably a good thing, that they're able to maybe get some efficiencies or reduce some of their material cost. So common size financial, take every line item and divide it by sales in that year, and you can see some trends. Let's talk about the cash flow statement, the last of the big three here. That's the balance sheet, the income statement, and statement of cash flow. The statement of cash flow just tells you what happened to the cash line item in the balance sheet. It changed from $1 amount to another dollar amount. What were the inflows and outflows to understand that change? It's broken up into three sections: cash flows from operations, cash flows from investing, and cash flows from financing. Cash flows from operation, we'll start with that one. And this balance, here's the statement of cash flow for this organization that we've been looking at. So we're going to first get cash flows from operations. What we're going to do is we're going to start with net income. In 2019, this corporation had $86 in net income. But again, I'm looking for cash flow, not profits. So in this 86 number, there was a depreciation of $90 in that year. So if I go back to my income statement, there's the $90. $90 is not a cash expense. The depreciation is not a cash expense. Remember on my delivery van example. So maybe this organization bought a delivery van several years ago, and it's depreciating, say, $90 of it in this year. So that is an expense that is not cash. It's kind of like a fake expense. It's made up. It's an expense that already happened a long time ago, and we're just recognizing it over time. So I'm going to take my net income and I'm going to add back depreciation because it's a non-cash expense. I'm then going to add deferred taxes. So any taxes that I had in the income statement that I haven't paid yet, that's a non-cash expense. So I'm going to add those two numbers back. And then I'm going to make three changes and related to what we call working capital. That is, I'm going to subtract any change in accounts receivable. So in 2019, accounts receivable, go to my balance sheet here. Look at accounts receivable, went from 270 to 294, an increase of 24. I'm going to subtract that change. Why? Because accounts receivable increased. So some of these sales of $86, I actually never received the cash because some people haven't paid me yet because it's sitting in accounts receivable. So I need to subtract the increase in accounts receivable to get back to cash. Likewise, I'm going to add changes in accounts payable. If I go to the balance sheet, accounts payable increased from 2018 to 2019 by $21. I'm going to add that change because some of the expenses in this net income number haven't been paid yet. So I need to add that back. And lastly, any buildup of inventory I need to subtract because it cost me cash, right? I paid to build the item which is sitting in inventory. That's nowhere in net income. So if my goal is to try to understand cash, changes in cash, I need to subtract that. So if I take my net income, add back my depreciation and deferred taxes, these are non-cash expenses in net income. I'm then going to subtract any changes in accounts receivable because that's a non-cash sale. I'm going to add any change in accounts payable, that's a non-cash expense. And then I'm going to subtract changes in inventory, which is a cash expense, not in net income. So this organization, from just doing their normal operational business, generated $197 in cash that year. You can see the big driver, it's a big difference in a corporation looking at cash flows from operations versus net profit. Because this company's reporting profit of $86, but it's actually generating $197 in cash. Primarily, the big driver is there's a bunch of non-cash expenses and depreciation. So cash flows from operations is the first category of cash, starting with net income and make an adjustment for non-cash expenses and revenues. The next category, cash flows from investing. All I need to do is subtract CapEx. So the purchase of a delivery van in 2019 would show up here. That would be the increase in the PP&E number at cost. And I also subtract any intangible CapEx. So any purchase of, say, copyrights or something like that. So if I take my cash flows from operations, this business from just operations generated $197 in cash. However, it spent $173 to purchase capital expenditures, long-term assets which last longer than a year. So that's gonna hurt if I'm an owner of this organization, I'm not going to be able to pocket my $197. It looks like I needed to maybe purchase some more delivery vans and things like that. So that cost me $173. And then the last category are changes from financing. So this organization increased its debt by $23. So I got an extra loan for $23. I paid a dividend of $43, so I subtract that. I bought back my own stock for $6, but I issued new common stock in the value of $43. So my cash flows from financing are $17. So as the change in cash of the organization, it generated $197 from operations. It spent $173 in investing. In other words, purchasing up fixed assets. And it gained $17 from financing activities, largely from issuing stock and issuing debt. So the total change in cash is $41. So $41, if I go back to my balance sheet, the change in the cash number is $41, and that's what I was trying to explain. So on this topic, we tried to understand the construction and analysis of a balance sheet, income statement, and statement of cash flow.